So, the topic of this budget, long-term capital gains.
Yes. I was surprised you didn't start with that in Chennai.
What is exactly the rationale behind this? Because you also said that you're going to review the Income Tax Act in the next 6 months. What was the urge to tinker with this long-term capital gains tax at this point in time? Especially considering that there are no major attractive proposals in the budget. See, whatever good you try to do has been overshadowed. The debate has been only on two issues in this budget: long-term capital gains tax and the money given to Andhra Pradesh and Bihar. The other aspects of the budget have been completely overshadowed because of these two. Why did you have to do this, LTCG?
It may be your perception that it's been totally overshadowed by these two because you're a financial newspaper. But I don't necessarily think that that is correct. But in any case, that's your view and I respect that. But coming to the capital gains, we had two motives. One, the primary one, was to simplify what we were told by perhaps, I'm not able to point to any of these three specific ladies as to what they've written, but there are a lot of people have been saying that our capital gain structure is very, very complicated, that, what is this? What a rotten tax code you have. If it's listed equities, it is 10%. If it's unlisted, it is 20 with indexation. Then if it is short term, this is 15, that is applicable rate. This short term is long term is 1 year. That long term is 2 years. Some other long term is 3 years. Listed REITs is 3 years, but listed equities is 1 year. What is this logic? Yes, it's true that it was a bit of a hodgepodge, evolved over a period of time, grafting of new sections over multiple budgets. It was not very cogent. It's an admitted fact. And there were representations to us from many sectors that they wanted this to be simplified. So motive A was simplification. And that, I think, undeniably, there is a considerable simplification. Almost everything long-term is at 12.5. And almost everything is now, if it's listed, it's 1 year for long-term. If it's unlisted, it is 2 years. So the 3-year category has gone. And most things are now unified at the 12.5% rate. So yes, it is simplified. The second motive was increasing revenue. So this was not a revenue neutral exercise. It is not unintentional that there is a revenue increase. If there is a revenue increase, it means a tax increase.
Does this lead to a significant revenue increase for you?
I am very confident that in the long run, this country's fastest growing category of income will be capital gains. And I say this with international evidence, with domestic evidence. The whole argument about inequality, etc., is primarily because of listed shareholding gains. And if that continues to be so concessional that the maximum rate of income tax is 39% if you are an MSME proprietor, but 10% if you are the owner of a majority shareholding in a large listed company, that is a recipe for low tax growth in the future because this will be the fastest growing category of income tax returns. And already the revenue from capital gains tax is significant. It is significant in spite of the fact that all gains up to 2018 are exempted. So yes, I believe it is significant. I believe it is not to be laughed at. It is not something insignificant. And we are building for the future. This is the income that will grow faster than salaries, faster than dividends, faster than interest, faster than everything else. And if we don't start taxing this now, we will not have the revenues that India will need to be a developed country in 2047, and our tax to GDP ratio is not high. Our capital gains tax ratios are not high by any. We get the constant comparison with Dubai and Singapore. We are not aspiring to be a city state. India is not a city state, cannot be a city state, will not be a city state. So if you look at every large country, their capital gains tax, even now, after this revision, are higher than ours.
No, my question was, why did you have to do it now? Why couldn't you have waited for the review of the Income Tax Act in the next 6 months?
That act review is not necessarily a taxing measure. That's a codification measure. So why should it be combined with that? That's a act simplification in terms of definitions, codes, what is in shortening the code, simplifying it. That's not necessarily a taxing measure at all. So, and budgets are made to raise revenues.
So you'll not be looking at rates or
that is a separate issue. That code, we have had several versions, and that is a complicated process that will go through a lot of consultation. And tying that to a revenue raising exercise, I don't think is prudent. Prudent from our financial point of view.
So you're saying that you looked at this from the investor's point of view to have just two rates and simplify.
Yes.
But from an investor's point of view itself, asset classes, if you take it, fixed deposits and debt schemes of mutual funds are taxed at slab rates.
Yes.
And,
they were yesterday also.
And you also have the Reserve Bank of India complaining that banks are not going after deposits.
So we are actually narrowing
banks
the
are
gap.
having a problem.
This is at the margin good for fixed deposits. It used to be 10 and 39. Now it's 12 and a half and 39. So it's not worse.
It can move the backward.
So we can raise it to 25 if you think.
No, you can drop.
Please make a suggestion.
Deposits.
Please ask them to write a couple of editorials that capital gains tax should be at the applicable rate, and we'll consider it.
Why can't fixed deposit rates also come at 12.5%?
It should not. The direction of travel may have to be the other side.
Because fixed deposits is
Believe me, this country needs taxation. The people in this room are not representative of this country in terms of population. I mean, this country needs taxation. We will have to gather taxation at moderate rates. People must get used to paying taxes at moderate rates. Our maximum rate of income tax is lower than most developed countries. Our maximum rate of capital gains tax is much lower than most developed countries. And we cannot have a world-class capital market and not expect to have some amount of reasonable taxes levied on capital gains. I think this is I have said this before, I think in the same forum about 2 or 3 years ago. And I think it is my personal belief, I'm not speaking for the government here, that too low a rate of tax on capital gains is unfair to all those who earn other kinds of incomes. Now, why should it not be 39%? There is a strong conceptual reason for that. Capital gains are not the same as other incomes. They are intermittent, they are lumpy. They come at odd points of time when you sell an asset. So if you were to tax it at applicable rate for long-term capital gains, you will actually throw somebody into a tax bracket which he would otherwise never have reached if it was accrued every year. So globally, capital gains tax rates are lower than income tax rates because they accrue over a period of time but are taxed in one particular year. And since we have a progressive taxation structure, if we were to do applicable rate for long-term capital gains, the year you sell something, your rate will jump to 39%. You may normally be at 15 or 20%. So that is not fair. There are countries like Canada which handle it by saying capital gains tax is at 50% of your applicable rate. So that's the Canadian system. Incidentally, in the April budget in Canada, that was raised to 66 and 2/3% from 50%.
So bad examples for us.
No, I'm giving you example. We want to be a developed country. I'm giving you developed country examples. So if it was 50%, that's one way of doing it. Most countries do it at a flat rate. Canada does it as a percentage of the applicable rate. So there is a justification for capital gains not to be at 39%. But should it be 15, 12.5, 20? There can be arguments. The government has decided that 12.5 is the right rate.
No, my question was more about...
And that it is more right than 10%.
My question was more about savings deposits and term deposits because that's where most senior citizens park their funds.
Correct.
And if that's taxed at the 30%...
So I think we are doing our best. We are not leaving lots of CASA deposits with the banks from the government now. So we are nudging them to increase their deposit rates. Earlier, the government, there was a lot of government float with the banks. We have gradually almost eliminated that through a just-in-time payment system. So you're beginning to see rates creeping up on fixed deposits.
I'm not done with this capital gains yet.
I know. I'm expecting most of this session to be on that.
Yeah. No. Indexation. The examples that the ministry has been putting out post the budget about 15%, 4%, they're very elegant in a particular way. But practically speaking, do you expect real estate appreciation to be 15%? I don't think it happens.
Actually, the break-even rate is only 10%.
8 to 10% is more realistic.
No. I'm saying that at above 10%, the non-indexed 12.5% is better than the indexed 20%. So if real estate gains are typically above 10%, then one is not worse off without indexation.
Yeah, but real estate gains are hard.
If real estate gains are less than 10%, then either there is rampant under-reporting of prices or people have made wrong bets in the worst kind of
real estate. You're talking of 10% a year.
Yes.
I don't think...
I'm afraid
I don't think there are many examples like that.
It is 10% a year. Most parts of India, people don't buy real estate to get a fixed deposit interest. They should go to the banks instead.
No, but I mean, you're looking at somebody who buys a house.
As an investor, they're also self-occupied house owners.
If you are self-occupied,
so
if you are self-occupied, first of all, if your capital gain is less than 2 crores, you can reinvest it in 2 houses and pay no capital gains tax. If your capital gain is up to 10 crores, you can invest it in 1 other property and pay no capital gains tax. If your capital gain is a mere 50 lakhs, suppose you say very lower middle classes, let's assume for a moment in this audience, maybe 50 lakhs is lower middle class in this audience. Normally it's not. But in this audience, let's say 50 lakhs is lower middle class. So 50 lakhs, you invest it in a capital gains bond and 5 years later, you are free of capital. So capital gains tax is almost voluntary for a person who has only 1 or 2 houses. Paying capital gains tax is a voluntary act if you have only 1 or 2 houses. We are mainly talking about people who have multiple houses, who don't want to roll it over into another house, who want to cash out and invest in something else. Otherwise, for those with one or, in fact, the first rollover provision, you can have 10 houses, and if you sell a house, you can still invest it in another house. So we have very liberal provisions for the taxation of capital gains on property, far more liberal than for any other kind of asset. So as far as the middle class is concerned, my advice would be roll it over. If you want to buy another property, buy a good property. You don't pay any tax at all. And in the case of property, you only have to reinvest the capital gain. In the case of other assets, if you want to roll it over, you have to invest the entire proceeds. So there are so many concessions for the property sector. 12.5% on the property sector. Again, I think for a sector which is relatively opaque, pricing is often undervalued for various reasons of capital gain, stamp duty, etc., etc. I think 12.5% is a reasonable rate of tax. And it's not, by the way, statistically, in revenue calculations, we are almost neutral at 12.5%. It's not intended to be a revenue gain or not a significant, it's marginal. It could go this way, it could go that way.
But you just said that you're looking at big gains from capital gains tax.
Equities.
Equities. Okay.
Equities. We're looking at big gains from equities, both short term and long term.
Okay.
Short term's gone up from 15 to 20% and long term from 10 to 12.5%. It is both a simplification and a revenue increase on the equity side. Yes, equity, there is a definite increase. No doubt that that's undoubtedly an increase. There's no question of trying to compare indexation or not. 10 is lower than 12.5. 15 is lower than 20. No question on equities.
One final question on this before I move on.
We are not anticipating any revenue gains from property, by the way. That's not our calculation.
Okay. So, you're talking of 12%, 12.5% now, and you're taking indexation away.
Yeah.
I know what your answer is going to be to this, but still I have to ask this. What is a guarantee that a future government will not be, and you're saying capital gains is going to be the biggest revenue earner for the government going forward.
It's the fastest growing income class in the Income Tax Act right now.
So what prevents a future government, now that the indexation is also gone, to take 12.5 to 15 or 20?
Nothing prevents a future
So
government. But this government has no such intention.
Then the taxpayer loses big time, right?
The tax increases have happened in the past. There was once a tax
but there was indexation.
At one
I'm
point
talking of property alone. There was indexation. The protection of indexation was there.
Yes.
So suppose the next
future
government
can
takes it to
theoretically bring
15%.
it back also. It wasn't there at one time. It came later. My friend was telling me it was Nani Palkiwala who argued for it and brought it. So there was a time when we didn't have indexation. Then we had a time when there was indexation. Now you're entering an area without indexation. It may change again. Governments have the right to choose, and every government which is elected has a mandate to modify these policies with the approval of Parliament. So I cannot give you an all-time guarantee on what will happen. I mean, that is subject to the government of the day. But I can say that there is no intention to change it any further. And this 12.5 was not intended as an increase on property. On property, let me make it very clear. This was the rate at which we could unify all the rates and simplify, which, by the way, was a prominent demand of industry and many taxpayer associations before. I am not making this up. You can check CII submissions to the government in the last 2 or 3 budgets on capital gains. They say there are too many rates, it is leading to arbitrage, this, that. So how do you unify without losing revenue? That is the task we have tried. And in equities, it is an increase. In property, for us, it is almost neutral.
Talking of securities transaction tax, your objective is to quell at least a part of the speculation.
No, our real objective is to collect taxes from a non-merit activity such as speculation.
Incidentally,
it may quell speculation.
How much upside do you expect from that?
Definitely about 7,000-10,000 crores. Not definitely. We don't know. That is also speculative. How much will the speculation go down is my speculation. So keep assuming that speculation doesn't go down too much. We should get some probably 5 to 10,000 crores.
So
extra.
Do you think this increase is good enough to at least address a part of the speculation in the market?
I am not sure. It's throwing a little bit of incremental sand in the wheels of speculation. Whether that's enough sand to stop it. We also don't want it to completely stop, because derivatives also perform certain functions in terms of those who need to hedge risks. And so it's not that if you wanted to stop it, you would ban it. So it's not stopping. It's a question of, at the margin, nudging investors into the cash, particularly small retail investors who may not understand the risks of what they're doing in the derivatives market, where you can be wiped out in one day. You can get a minus 100% in the derivatives market on a single day, which you cannot get in the stock market. I mean, you will not get because there are circuit breakers and so on. So the aim is to, at the margin, deter trading in futures and options, particularly by retail investors, but at the same time collect some revenue from it.
Okay.
Revenue collection, by the way, is not something that should not be done. Though financial newspapers think it is some wrong thing that we are doing, we actually intend to collect some revenue also.
Financial newspapers represent the capitalist class, so obviously they are not very happy.